back. This is Business Today. We're about to move into the financial sector on today's show, talking a little bit about what's happening in the Colombo stock market. Two important things happening this week. The first, of course, is the depreciation of the rupee, that has been having a lot of negative spillovers in the market. Second topic on today's financial stories is that the Sri Lankan exports global share is lower than the pre-independence era. So talking a little bit about it, the Sri Lankan exports are extremely low and is definitely below the world market share. That was when it was in 1947 that prevailed before independence, says the Sri Lanka Exporters Association President Sarda De Silva. He said that currently exports have come down from 31% to 15%, and it is a very, very concerning and alarming situation. So that's something we want to talk about in detail today, as well as the depreciation of the rupee. Let's welcome our guest today. Well, to talk to us about the financial market, the stock market, we have with us Mr. Shiran Fernando, Senior Economic Analyst and Product Head of Economic Research from Frontier Research. A very good evening to you.
Very good evening to you.
We want to talk a little bit about Mr. Shiran Fernando at the outset of the program. He oversees economic and equity services at Frontier Research and leads macroeconomic presentations catering to senior level management team and plays an instrumental role in building strong business entrepreneurships with top and middle level management. So he's also been instrumental in building up new products such as the Trader's Edge report, focused on short-term trading and local government securities while contributing to the continuous innovation and improvements of Frontier products, which is why we think he's the ideal person to talk to us about the rupee depreciation. Tell us what's been happening and how that will affect Sri Lankan economy.
Thank you very much for this opportunity to discuss this with you. I think the rupee depreciation has come after a lot of pressure that the rupee has been under against the dollar. We price ourselves against the dollar generally as a benchmark. And since I think the end of last year, we've seen pressure on the rupee, largely because we've seen imports going up, as well as we've been servicing a lot of debt. And globally also there has been changes which are not favorable to the rupee. But the question is, now the rupee, you're hearing it going from 134 to 140, and it now slowly inching upwards, 141, 142. Daily these changes about. But the question is, how did we get here? And that's the very interesting point is that our economy is very cyclical in nature. So we go through these cycles where it's typically what you know as boom and bust cycles, where we have low interest rates. The central bank, I think, has been maintaining low interest rates for about a couple of years now, and accompanied by loose fiscal policy. And what I mean by that is very good budgets catered towards providing consumers with more disposable income. And we've seen that with the recent budgets as well, with increases in allowances. So all that has sort of fueled what we known as the demand in the economy. And the demand in the economy typically is unsustainable because we start importing. As you highlighted, I think, earlier in the show, vehicle imports are up, consumer imports are up, a lot of these items are up. And what's interesting is we went through this cycle in 2011 as well, where the rupee was around 110. And 2011, it was under tremendous pressure until it was again devaluated by about 3% in November 2011, after which the rupee, once it floated, went to about 134 at the peak, 134, 135 at the peak. We're seeing some similar trends now as well. The rupee was let go, I think, on the 4th of September, and since then it's gone about 6 to 7 rupees. But what's right now the trigger point is that we've had a lot of debt outflows compared to 2011. So that's one of the key differences. So imports probably in terms of growth is not as high as 2011. We're having a lot of debt outflows and debt servicing, and also foreigners leaving the local build and bond market as well as the equity market. So that sort of dynamic is impacting the rupee right now.
Today's newspaper says that the rupee depreciation it's chasing away foreign participation in the finance market. From the Colombo Stock Exchange, a lot of foreigners are pulling out. A lot of selling is happening both in the stock market as well as in the bond market. How is this affecting the economy?
This is affecting the economy in the sense of we are reliant on these inflows. I think especially in our bond market, we need these inflows to fund our deficits, especially on the balance of payments. When you look at it, you need these inflows to compensate a lot in the financial markets. And in terms of equity, the number is small compared to the bond market. Equity is also a sign of health of the economy. So these investors leaving is not a good sign for the economy. But also this is in the backdrop of a lot of Asian peers and emerging market peers. I think India is under pressure, Indonesia is under pressure, Malaysia is under tremendous pressure. So we are sort of in that trend, if I was to put it. So it's not something unusual, but it's not healthy for the economy, especially given we're having a bit of balance of payments pressure, which is having an impact on the rupee and as well as interest rates.
Right, we want to talk a little bit about interest rates and, of course, the impact this whole situation has. But before we do that, we want to talk a little bit about interest rates, what it means to someone out there in the public. All what they see is they hear all these advertisements, they hear the commercials, interest rates are X percentage, etc., etc. That's all they know about interest rates. But how important is our interest rates?
Interest rates are very important because that's what people get for, that's a return, or that's a benchmark return that they get for what they save or what they invest in. So typically, the central bank is, a key role of the central bank is to monitor this and monitor the level of rates that banks lend out, financial institutions lend out. So they maintain what you call a deposit rate as well as a lending rate. And whenever there's an easing cycle, which is central bank cutting rates, you see deposit rates falling. Now, since I think December 2012, we've been on an easing cycle, which is where basically central bank cut policy rates, which in turn means deposit rates came down as well. So when I go to the bank and open up a fixed deposit, what I was getting about 10%, if I was getting about 10%, say in the end of 2012, I'll probably be getting about 6-7% now. That's what you call a reduction in interest rates. And also we've seen that in lending as well. Lending rates have come down drastically as well from highs in 2011. So that is sort of prompted with the fiscal allowances, has sort of prompted people to go out and get make purchases, for example, consumption purchases or investment purchases like getting a vehicle. So these things matter, and it also matters for the equity market as well. So when typically interest rates are low, you're getting a very not low return on your investment, but comparatively to what you were getting earlier. Say if you were getting 10% before, you're now getting 7%. So you would feel like investing more in the stock market because that typically is a more riskier asset class with higher returns if you invest wisely. So that'll cause people to go and invest in the equity market. But if interest rates are on the rise, which we also feel has happened in the last few months and will continue to happen, equities and the stock market would not be a favorable choice for investors.
Right, so we were talking about the rupee depreciation. The whole reason I asked you to define and explain what interest rates do, what it means, is to talk a little bit about the role it plays in this case-specific time, what happens with rupee depreciation and what it means for interest rates.
So in terms of the rupee depreciation, what it does is it could have an impact on inflation. Inflation right now is quite muted. I mean, we're sort of in deflation territory. It's if you look at what it was in August compared to what it was in August 2014, it's a negative growth. So with the increase in with the depreciation, our import costs would rise and inflation could be on the rise. So that has an impact in terms of interest rates as well. But the depreciation sort of would ease the pressure in terms of funding, both locally and foreign as well. That easing of pressure in the financial markets would sort of mean that the money markets as well as the bond market pressure would also ease. And I think a lot of investors, those who are exiting the market, are pricing in a depreciation of a certain value. I mean, it depends which investor you meet, but they're pricing in this as well. So the depreciation is sort of letting, if you see a more increase in depreciation, that's what we've been also telling clients, that if you do see greater depreciation, then the impact on interest rate adjustment could be much less. But if, for example, the central bank manages to hold the rupee around 140 levels, we could see a further rise in interest rates, because interest rates, a lot of the pressure is coming from defending the rupee and the liquidity levels which comes with that. So if the more we defend the rupee, the more liquidity levels will reduce, and when liquidity drops, we'll see pressure on rates. So right now you're seeing financial markets reacting. You've seen, for example, if you look at a 5-year local government bond increasing more than 100 to 200 basis points, which is 2%. You're not seeing that change reflected in deposit rates. So for the viewers out there who are depositing in banks and financial institutions, right now banks have not as yet, to my knowledge, started increasing deposit rates. But slowly that will translate in a rate rising environment. You'll see first the financial markets reacting, and then you will see banks and financial institutions adjusting and repricing what they're giving it at.
Right. So the other hot topic on today's papers is the exports. What's happening in Sri Lanka? Exports are at an all-time low. They're saying they're lower than pre-independence levels. I want to talk a little bit about exports and remittances now.
In terms of exports, I think this year has been slightly disappointing in terms of growth. If you look at the first half of this year compared to last year, exports are actually down in terms of growth rate. A lot of the factors are due to, for example, seafood exports because of the ban that the European has imposed on Sri Lanka. Tea exports are struggling because of what's happening with Russia and the Middle East and those countries. And apparel exports are are growing, but they're sort of waiting for that stimulus, which will come either through a rupee depreciation or GSP plus, and all these factors that come into play probably next year. So right now, exports are stagnating. But I think with the rupee depreciation, we could see exports picking up. And if this government, they've sort of hinted that they want to play a bigger role or give more emphasis towards exports, especially apparel, then we could see this industry taking off and helping us get the foreign exchange that we need, so that we don't fall into this cycle of balance of payment crises and current account crisis, which leads to rupee devaluation at the end of it.
So the fact that Sri Lanka is exporting less exports, does that mean it's mostly due to external factors? I mean, because mostly we used to export a lot of fisheries and apparel to the EU. Then we had this embargo from Sri Lankan fisheries. So, and then we had the oil crisis affecting purchasing power of Russian countries and other given countries, because they're significant buyers of Sri Lankan tea. So are you saying that this would have been due to external shocks? The fact that exports are low, does it mean it's due to external shocks?
I think on the demand side, yes, the buyers of Sri Lankan exports are seeing a bit of weakness in the economy. So naturally, the demand will reduce. But even if you look in the region, so for example, South Korean exports, Singapore exports, these key benchmarks are also contracting. China, for example, a lot of the financial market turmoil that you're seeing right now is because of the Chinese economy not doing too well. And exports also not meeting expectations because they're looking at exports driving growth. So you've seen the Chinese yuan devaluating about 3 to 4%. So it's sort of like a regional phenomenon that's happening. And that also has to do with a lot of the fact that global GDP is sort of not growing at the pace that a lot of people expected. Because coming out of a financial crisis in 2007, 2008, a lot of forecasters thought that by now global growth would be quite healthy. But barring, I think, USA and a few other countries, global growth is sort of muted, or it's not up to expectations. So I think largely it's due to demand and
not to do with Sri Lankan supply side factors.
I don't think it's largely to do with Sri Lankan supply side.
All right. What is your opinion on the future outlook that holds for Sri Lankan economy?
I think policy right now, I think there's a short window of time where we can look to make adjustments, favorable adjustments. But we also need to provide policy consistency as well as policy clarity. For example, if there is the willingness to get these foreign bondholders who've left the markets back, there needs to be proper communication within that. You also need to identify which sectors you expect to grow and provide incentives for that. But I think once we pass this episode of adjustments, be it interest rates and exchange rate, which we feel has been coming, and we've been saying that to our clients since April of this year. Once we, I think, pass this episode, and if the global economy does pick up as well, and we move past this volatility with the Fed raising rates and Chinese volatility that's coming in, I think once we move past this window and once policymakers and political stability sustains, I think there is a massive window of opportunity for Sri Lanka to capitalize on getting FDIs, which post 2009 hasn't come in as expected. So FDI to come in, and also all these other niche exports to also bloom, using our strategic location and losing our skill. Within the next 3 to 4 years, once we've weathered this storm, to actually move forward.
Right. I want to ask you one more question. That is, what can we expect from Sri Lankan policymakers to reduce the said shocks, to reduce vulnerabilities of the economy?
I think the fundamental thing is to understand that there could be that you these risks early on and planning for it, and not doing the same mistakes, not repeating the same mistakes of having loose monetary policy. That means very low interest rates for a long period of time, and that fueling consumption boom. But identifying this risk early on, and then moving to other sectors to make sure that you get those foreign exchange earnings, which will support our deficits, fiscal deficit or the current account.
All right, with those remarks, I think we'd like to thank you very much for being with us today. We're in conversation with Mr. Shiran Fernando, Senior Analyst in Product Head Economic Research from Frontier Research. Thank you very much for giving us a very technical yet very interesting insight into two very hot, very current topics Sri Lanka has to face. Thank you very much for your time.
Thank you for having me.
With that, we'd like to take a look at some of the other financial stories making headlines overseas as well as here at home.